We do have our movers and shakers segment where we track a whole host of stocks which are buzzing in trade. And first up, we have Rima joining in on TechM. The company's FY27 goal is of revenue growth, which is higher than peers with EBIT margins of around 15%. Rima's here with me.
Indeed. So while the company did reiterate the broad FY27 growth numbers, growth expectations, and it did well in Q2, the stock could be lower on account of, the fact that in FY27, growth is not going to be great. In fact, the company themselves lowered expectations for FY27. What they said in the press conference is that FY27 to be better than FY26 from a revenue growth perspective, but the revenue growth rate will be slower than the earlier expectations on the back of macro uncertainty. Also, the company analysts point out that, for the company to achieve industry-leading growth in FY27 appears to be a bit challenging. So CLSA says, and I quote them in the report, the bigger ambiguity is around the company's ambition to grow higher than the peer average in FY27. FY26 revenue growth seems to be in line or lower than peer average. BofA expects the company to do flattish growth this year and just about a 3% growth next year. On the margin front, though, the analysts like the progress. CLSA says the EBIT margins today are 12.1%, and getting to 15% does not seem very arduous. For the full year FY27, BofA expects EBIT margins at 12.7% and an expansion compared to the 12.2%. So the margin performance is fine. It's just that on the revenue growth, FY27, it just appears that the company has toned down certain expectations, and that could be weighing on the sentiment today.
Okay, Rima, thank you so much for that. Surely keeping an eye out on TechM. But Ekta, you're keeping an eye out on Thyrocare as well, and this is after its numbers, right?
Well, yes, I'm looking at Thyrocare because it reported what was a good set of numbers this time round. So I'll just take you through what they reported. The revenue was up around 22% on a year-on-year basis, and it was a 12% growth on a sequential basis. We had margins which expanded to around 33% versus around 27% year-on-year and 30% Q-on-Q, and the profit was up around 80% year-on-year and 25% sequentially. Now, the main bread and butter business, which is basically pathology business, saw 24% growth year-on-year to 202 crores. Franchise revenue, which is basically opening franchises on the Thyrocare name, was up 20% year-on-year. The company, remember, is also debt-free with a net cash of around 190 odd crores. What also enthused the market is that the company is going to be issuing bonus shares at around a 2:1 ratio and has declared an interim dividend of around 7 rupees as well. So all-round positivity which is coming in for Thyrocare. But let's go back to Rima because she's looking at Persistent Systems, which has gained over 6% after its Q2 numbers. Rima, tell us more.
So, JM Financial calls Persistent's quarter a near-perfect quarter. Nomura says it's an all-round performance in Q2, while CLSA has a high conviction outperform rating on Persistent. Now, the company's done well. It's beaten expectations on revenues and margins. Revenue growth is 4.4%. And if you look at the dollar revenue growth, it's been above 3% for 22 straight quarters. That's phenomenal consistency. Margins, too, have expanded by 80 basis points to 16.3%. The company is guiding for 100 basis points margin expansion this year, FY26, despite the wage hike which kicks in 1st October, and another 100 basis points expansion in FY27. Brokerage view is positive to neutral. So the bullish calls are from JM, CLSA, Nomura, HSBC have a hold neutral call, and Ambit has a sell call on the stock. Now, the reason why Ambit has a sell call is because valuations are on the higher side for Persistent, and according to their calculations, close to about 42 times forward multiple. But CLSA likes the story because this is a company, according to the calculation, growing 29% EPS over FY25 to FY27, and JM Financial likes the consistency.
Okay, all right, Rima. Thanks very much for that. Well, we now have Upasna who's joining in on Cyient DLM. The stock is under pressure. She's here to tell us more. Upasna.
Well, overall, it was a weak quarter for the company. Revenue and PAT missed the street estimates, but margins were largely in line with what was the street estimating. Now, coming to the revenue first, it stood at 311 crore with a degrowth of 20%. Now, this revenue growth was impacted by completion of a large order, is what the company has indicated, and the defense segment saw a Y-on-Y degrowth of 90% due to a large order completion, which is why it impacted the overall overall revenue of the company. EBITDA stood at 31 crore with a downtick of 1%, but EBITDA margins saw an uptick of nearly about 191 basis points at 10%, which was largely in line with the street estimates. Now, EBITDA margin mix was mainly skewed towards the company's aerospace division, which now stands at 37% of the overall sales. Now, coming to the PAT numbers, mind you, this time there was a one-off this quarter of nearly about 9.5 crores due to the other income gain, which is why the normalized PAT is perked up. But if we look at the PAT numbers correctly, it stands at 12.6% crore, which is down nearly about 18%. So in terms of order book, if we see, the order book has seen a growth of 16% on year-on-year basis and a sequential growth of 7%.
Okay, Upasana, thank you so much for that. But on that note, we're actually going to slip into a very short break. We'll get you more on the markets and focus on RBL Bank as Emirates NBD eyes 60%.